Officer over at BNY Mellon Lockwood Advisors with his 2020 outlook. Matt, it's great to have you with me as always. And 2019, despite all the uncertainty out there, S&P up almost 30% on the year. Question is, 2020, what do you think that's going to look like?
Yeah, well, we're kind of ending the year on a really strong note. I mean, every movie that you ever see of Santa's sleigh, at the end of the movie, taking off to deliver the toys to all the good little boys and girls. The naughty boys and girls might not get anything, but investors must have been awfully good this year because despite 4 quarters of earnings recession, trade talks that really weren't resolved until the end of the year, a Brexit decision looming over the markets, really subpar economic data for almost all of the year. Markets are up 30%. They're up at record highs practically all around the world. So, and practically everything was up. It wasn't matter if you owned gold, you did well. If you owned bonds, you did well. Investment grade bonds were up 15%. So virtually anywhere that you looked, you had some really good returns for 2019, and that's a great thing to celebrate here.
It certainly is. I mean, if you were short, it's just been a tough year, and I think that goes with being long and staying invested, right?
Yeah.
Look at December, that was a fantastic buying opportunity. Of course, hindsight being 2020, but these dips in the market is what makes averages. Going back to the impact of trade on the markets, with that outlier in the marketplace, it really didn't make that much of a difference. Do you think we'll see more of that impact in 2020?
Could be. I think as long as there's positive momentum on trade, I think that's all the markets need to see. I mean, the United States has been trading with China since 1784. Actually, a ship left New York Harbor in 1784, and it was the first under an American flag that left the trade with China. And if you look at the trade of China, it was very politically managed. And that's very much true today. Very little has changed. Maybe the goods have changed. We exchange things like ginseng and timber for porcelain and fabrics and textiles. But we're still having these same very politically managed process that's still going on, and investors don't have a lot of insight into what's going to happen around Chinese trade. So here we're going to get a first phase 1 deal. Looks like that's going to be signed relatively early in the next year. I think that's a positive for markets. It's just taking a lot of time. And it's taking a lot of time, and it's also very important for markets. We need to see this process continue to unfold as time moves on, and I think that's all that markets will need.
Well, the next question is valuations. How much higher can they go?
Yeah, so think about what happened last year. Obviously, we had a 20% decline, or on the cusp of a bear market there in December. But this year, we're not going to have that tax loss selling coming into the end of this year. So that's a positive thing. Also, we have to remember that the Fed has been very instrumental in supplying liquidity to the repo market or short-term financing market, and that's going to start moving out to the long end of the curve in time. It's one of the things that's helped valuations stay relatively high. But the earnings numbers have actually been relatively weak, and we've seen 4 quarters of an earnings recession in the US, so it's just another one of the surprising things for why markets would continue to rally in that process. So we actually need to see earnings get a little better. I think it's rather unlikely to see the valuation multiples could continue to expand too much in 2020, so I think that has to mute your outlook. We've pulled some of the gains for 2020 into 2019, but if you think about it, we spent a lot of the year just recovering from what happened in December. So, I think, if you X'd out the 20% that we got in December, on a 13-month return, we're up 9 to 10, which is not bad, but, you have to take out that one big pothole that we hit, as we went into the end of the last year. But there's still other structural things that are helping the market outlook. One of those is a tax cut that's continuing to help support buybacks for shares in next year. That's still intact. So I think, remember also, it's an election year, so I think we will have to start to begin to digest that. Polls are showing, a Bernie Sanders, winning in New Hampshire and Iowa at the moment. We'll see if that continues to hold. If that's true, I think that's going to make the market ask some harder questions by around even Valentine's Day. So we're only a couple weeks away from starting to see some of the early results in the primary elections that we're going to go through 2020. I think that could affect the market outlook as well.
Tax cuts were good for buybacks, but it doesn't mean anything in terms of CapEx going back into the company, and that sets up for future growth. That's a concern on my end.
Yeah, I think that's a concern of everybody. We really haven't. We're going to get a durable goods orders tomorrow in markets, but we really haven't seen a lot of the follow through, and part of that might be because interest rates are really low. So corporations have been able to borrow any money that they've really wanted to expand property, plant, and equipment they didn't have the need for a tax cut to be able to make any kind of investments there. So it has supported some aspects of the market, and it certainly supported the buyback picture and dividends. So we've had other ways of returning capital back to shareholders, which I think has been a real positive last year. If you look at the flows, a lot of money came back in from buybacks back into the market, despite retail investors actually leaving the market. So concerns about valuation and concerns about the length of the cycle are definitely weighing on retail advisors and investors' minds, but there's other pieces of support. And most of those pieces of support are still going to be there. It just, we may have gotten a little bit ahead of ourselves on a short-term basis, just with optimism and sentiment for what the macro picture looks like going into early next year.
What about foreign versus domestic allocations?
That's a great point. So that spread has been so wide between foreign shares and U.S. shares. It's possible that if the U.S. outlook doesn't look all that great because of valuations, maybe investors will start to find other pockets of the market that hasn't been up as much. They're still at record highs now. Foreign shares are also at record highs. But I think there could be more pockets of value around the rest of the world than there are here. If we begin to see some of this stabilization in the macro numbers, which we've started to see the last few months, I wouldn't say it's super optimistic in what we've seen in terms of PMIs or surveys around corporate activity, but it's been a lot better than it was a few months ago. And if we're able to carry that into the first half of next year, I think it's really going to help support international stocks and emerging market stocks as we look at 2020.
All right, and to wrap up here, sectors that you're considering for 2020.
So we're interested in the energy sector right now. It's a place that has been so beaten up. The sentiment is terrible. I don't know that I've seen it as bad maybe in my career. So it's pretty much been left behind by the rest of the bull market. And you have an energy sector that's paying 3.5% dividends. So that's a good news. And I think there's catalysts. There's still a lot of geopolitical tension. There's things that could force energy prices to go quite a bit higher. If we do see some of this turnaround in the overall macro picture, it's going to be good for energy shares next year.
All right, Matt, thanks so much for joining us at MarketSite as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.